Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today I thought I'd talk about settling your debt with the IRS. And you can't watch television anymore without seeing some of these IRS program commercials where people are trying to get you to call them about settling your debts with the IRS. So I thought I'd talk a little bit about that because there's a lot of misinformation out there about how all this works. And one of the things you'll hear them say in these commercials, I settled my debt for pennies on the dollar. Well, let me tell you right now, that is definitely the exception to the rule. In general, the Internal Revenue Service is willing to work with you, in an installment plan where you take the full balance of the tax that you owe plus penalties and interest that continue to accrue, and they'll work a payment plan, between 48 and 60 months for that. But, if you're going above that and you're looking for a way to settle your debt, then one of the things you can consider is an offer in compromise. You need to understand that when the IRS is looking at an offer in compromise, the IRS is not going to accept one of these OICs, as they're called, unless the amount offered by a taxpayer is equal to or greater than a reasonable collection potential. So basically what they're saying here is the IRS is not going to approve these if you can afford to pay. And I've had a lot of clients call me and say, hey, Ralph, can you help us work on an offer in compromise? And, my first answer is generally, listen, if you have the ability to pay, the IRS wants you to pay them. Now, I've helped negotiate some of these settlements, but they're very unusual and very difficult to get. I generally tell clients, look, if you're not working, and you don't have any potential to work, like if you're disabled or something like that, you may very well qualify for one. But it really is a complicated situation. But I thought I'd take a few minutes and talk about it. So there's really 3 reasons that the IRS has to accept an offer in compromise. They can accept an offer in compromise if there's doubt as to liability. And we'll talk a little bit about that here shortly. But that means a compromise meets this only when there's a genuine dispute as to the existence or amount of the correct tax debt under the law. The second is the IRS can accept a compromise if there's doubt about the amount is owed is fully collectible. What they call this is doubt as to collectability exists in any case where the taxpayer's assets and income are less than the full amount of the tax liability. What we're talking about here, we talked about is the reasonable collection potential. And thirdly, the third reason that they may accept it is the IRS can accept a compromise based on effective tax administration. And that's a fancy way of saying an offer may be accepted based on effective tax administration when there's no doubt that the tax is legally owed and that the full amount owed can be collected, but requiring payment in full would either create an economic hardship or would be unfair and inequitable because of exceptional circumstances. So, if you watch these TV commercials and they talk about, I settled my debts, for pennies on the dollar, they've got to fit into one of these 3 things, and that is doubt as to liability, doubt as to collectability, or effective tax administration. Now, I don't want to get into the weeds about how this is done, but there's basically, an OIC form. It's called a 433A, which is what people who work for a living for someone else, like a W-2 earnings, would use, or if they're self-employed, and a 433B, which is a collection information statement for a business. So if you're somebody who owns their own business, you're actually going to be probably filling out both of these documents to get started. Now, before we even get started with that, you've got to realize there is a application fee for that. And the application fee, is based on your income. So there's 2 exceptions to that, and I want to get into the weeds with this, but there's no application fee if it's one of those doubts as to liability, or secondly, if you qualify for the low income exception. So let's assume that the IRS is going to allow you to file this offer in compromise based on one of the 3 reasons for the offer. Now, once that happens, then you've got 2 options on how to pay that. And let's talk about those. There's 2 payment options. The first one's called a lump sum cash offer. This is where the taxpayer may choose to pay off an amount in lump sum or installment payments. A lump sum cash offer is defined as the offer payable in 5 or fewer installments within 5 or fewer months after the offer is accepted. If a taxpayer submits a lump sum cash offer, the taxpayer must include with the Form 656, again, I don't want to get lost in the weeds, a non-refundable payment equal to 20% of the offer amount. So what they're saying here is if you're going to make this lump sum cash offer, and you see this advertised on television all the time, I settled my debt for pennies on the dollar. So let's just say, that you owe $20,000 in tax debt, and you say, look, okay, IRS, here's what I'm going to offer you. I'm going to offer you, $5,000, 25 cents on the dollar towards this debt. Well, the bottom line is that you've got to make this application fee and then include 20% of that offer as you send in your money. And the IRS does not have to refund that. Meaning if your offer gets rejected, they're going to keep that money and apply that against your tax liability. So that's something you have to take into consideration. Second thing, you can do periodic payment offer. This is often called a periodic payment offer under law if it's payable in 6 or more monthly installments within 24 months. So the first one was a lump sum due in 5 payments or 5 months or fewer. And this periodic payment offer is one in 6 payments or monthly payment installments within 24 months after the offer is accepted. When you submit this type of offer, you must include the first proposed installment payment along with the form, like we talked about. This payment is required in addition to the application fee. And this amount, again, is generally non-refundable, just like the 20% payment for the other. Also, while the IRS is evaluating a periodic payment offer, the taxpayer must continue to make the installment payments provided for under the terms of the offer. So if you're going to do one of these offers with a periodic payment, you got to start making those payments in the time that you've agreed to make them. Now, when this happens, and you go into one of these offer and compromises, it does suspend collections. Ordinarily, the statutory time within which the IRS may engage in collection activities is suspended during the period that the OIC is under consideration. And if further suspended if the OIC is rejected by the IRS, where the taxpayer appeals the rejection to a board of appeals. Now, we talk about the offer terms. If the IRS accepts the taxpayer's offer, the IRS expects that the taxpayer will have no further delinquencies and will fully comply with the tax laws. Now, what happens is if the taxpayer doesn't abide by all the terms and conditions of the OIC, the IRS may determine that the OIC is in default. And if they do that for doubt as collectability and effective tax administration, the terms and conditions include a requirement that the taxpayer timely file all tax returns and timely pay all taxes for 5 years of the date of acceptance of the offer. So once the IRS, if you're lucky enough to get one of these accepted, you've got to live by this rule that you're going to have to make sure for the next 5 years all of your taxes are paid on time, because if not, what happens is the IRS will call this a default and go back to and originally collect the amount that you were owed. Now, this being said, you've got the right to appeal this if the IRS turns you down, and they give you what's called a 30-day appeal letter, and sometimes, they just flat out reject it because the taxpayer didn't submit necessary information, filed for bankruptcy, or failed to include required application fee or non-refundable payment. And let me just tell you something, having done some of these, this is a cumbersome process, and you need to make sure that you've got all your ducks in a row, because they look for every opportunity they can to not approve this. So you've got to make sure you've included all the things they've asked you to include. You got to make sure you've put all your bills in there. Well, anyway, I hope this was helpful talking about offers and compromise.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.